Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Chris Genova, mortgage broker in Grey Bruce Region, Ontario.
If you've spent years writing off every legitimate business expense you're entitled to, vehicle, home office, equipment, and then sat down at a bank to qualify for a mortgage and watched that strategy work against you, this episode is going to explain exactly why that happens and what to do about it.
That scenario is more common in Grey Bruce than most people realize, and it catches business owners completely off guard.
Let's start with a real situation. A contractor in the region, strong business, 4 years in, generating solid revenue, sits down at his bank to apply for a mortgage.
And the bank looks at his T1 generals, sees the net income after all his legitimate deductions, and the number on paper looks nothing like what he actually brings home.
The bank declines him, not because his business is struggling, because his accountant did exactly what a good accountant is supposed to do.
That's the core tension in self-employed mortgages, and it's structural. The tax system rewards you for minimizing taxable income. The mortgage system qualifies you based on that same minimized number.
And those two systems are not talking to each other.
Chris Genova has been navigating that gap for self-employed borrowers across Grey Bruce for 26 years. Owen Sound, Collingwood, Meaford, Hanover, the surrounding communities.
So let's talk about why the standard process fails self-employed borrowers before we get into how Chris Genova approaches it differently.
The default approach at most major banks is to average net income from the last 2 years of T1 general tax returns and notices of assessment. That's the number they use to qualify you.
So if your write-offs are significant, and for most self-employed people in Grey Bruce, they are, that average can be surprisingly low relative to what you're actually earning.
A business owner clearing $120,000 in revenue but reporting $65,000 in net income after expenses is qualifying on the $65,000. And then the stress test applies on top of that.
Right, the federal stress test. Walk us through what that actually does to the numbers.
The qualifying rate under OSFI's guidelines is the higher of the contract rate plus 2%, or 5.25%, whichever is greater. For a self-employed borrower whose qualifying income is already compressed by deductions, that stress test cuts the approved mortgage amount significantly.
So you've got two forces working against you at the same time, deductions reducing the income figure, and the stress test reducing what that income can support.
And salaried applicants feel the stress test too, but they're not also dealing with the income compression problem. Self-employed borrowers feel both.
This is where Chris Genova's work in the Grey Bruce region becomes genuinely important. Because the answer isn't just, report more income, it's more nuanced than that.
The first thing Chris Genova does is understand which income documentation method actually fits the file. There are two distinct approaches, and choosing the wrong one at the start is what leads to avoidable declines.
Break those down for us.
The traditional method is what the major banks use, averaging net income from 2 years of T1 generals. Straightforward, but it penalizes borrowers who have maximized their deductions.
And the alternative method?
Alternative income verification uses business bank statements, a professionally prepared profit and loss statement, or a combination of invoices and contracts. Some lenders, primarily B lenders and private lenders, will use those documents instead of relying on tax returns.
And that can produce a significantly higher qualifying income for borrowers whose gross deposits tell a completely different story than their net tax income.
Exactly. The trade-off is rate. B lender rates sit higher than A lender rates. But for a borrower whose tax documents underrepresent their actual income, that approval is real and the mortgage functions the same way.
And Chris Genova's point is that the B lender path isn't a last resort, it's a legitimate tool. It's a bridge.
A borrower who qualifies through a B lender today, makes on-time payments, and builds a stronger documentation history. That A lender conversation becomes a very different one a couple of years later.
That's the transition strategy. And it's part of the planning conversation from the beginning, not something you figure out after the fact.
That's what 26 years of matching self-employed mortgages in Grey Bruce to the right lender tier actually looks like in practice.
Let's go back to that contractor. The bank declined him. What actually happened next?
The file went to a B lender using business bank statements as the income basis. The approval came through. He purchased the property.
And the bank decline wasn't the end of the file. It was a signal that the file needed a different lender and a different approach.
Chris Genova is direct about this. A decline from a major bank often means the income documentation didn't fit that bank's underwriting model. It doesn't mean the borrower is a poor credit risk.
The Canadian mortgage market has 3 tiers: A lenders, banks and monoline lenders; B lenders, trust companies and alternative lenders; and private lenders. Each tier has different income documentation standards and different qualifying criteria.
A file that doesn't fit an A lender's model may fit a B lender's model cleanly. Knowing which lender to go to based on the specific documentation you have, that's the work.
Now, down payment is another piece of this that matters more for self-employed borrowers than most people realize.
The threshold at 20% is significant. Below that, you're in insured mortgage territory. CMHC insurance, and the income documentation requirements are the same as for salaried borrowers. T1 generals and NOAs.
So if your documented income doesn't support the purchase price under CMHC's guidelines, you either need a larger down payment or a lender who doesn't require CMHC insurance.
Reaching 20% down removes that insurance requirement and opens access to lenders who have more flexibility on how they assess self-employed income. For some files, that threshold is the unlock that makes everything work.
And Chris Genova raises something that Grey Bruce business owners specifically should hear. If you have equity in an existing property, that equity can sometimes be used as the down payment on a new purchase through a refinance or a home equity line of credit.
That's a conversation that requires looking at the full financial picture. What the existing property is worth, what's owed, what the refinance would cost. But the option exists more often than people assume.
Let's talk about the tax strategy piece, because this is where Chris Genova's perspective is really sharp.
The single most common issue in self-employed mortgage files is a mismatch between the borrower's tax strategy and their mortgage goals. And it's entirely preventable with early planning.
The accountant is doing their job, minimizing taxable income. But minimizing taxable income also minimizes the income the lender will use to qualify you. Those two professionals need to be working from the same set of goals.
In some cases, the right move is to report slightly more income in the year or two before a planned purchase, accept a modest tax bill, and use the higher documented income to qualify for a better mortgage.
In other cases, the alternative income documentation route through a B lender is the cleaner path. The answer depends on the specific numbers.
And Chris Genova's point is that this conversation needs to happen before tax season, not after. Once the returns are filed, your options are more limited.
For Grey Bruce region business owners, tradespeople, contractors, farmers, shop owners, consultants, the income picture is often more complex than a single annual number anyway.
Seasonal revenue, project-based income, multi-source earnings. A strong year followed by a reinvestment year can produce an average that looks weak even when the business is genuinely healthy.
Knowing how to document and present that story to the right lender is part of what makes self-employed mortgages different from a standard application.
It's not just paperwork. It's a case being made on your behalf by someone who understands both the lender landscape and the realities of running a business in this region.
If you're a self-employed borrower in Grey Bruce and you want to start that conversation with Chris Genova, come prepared. The first call goes better when the numbers are in front of you.
For a traditional income verification approach, you'll want the last 2 years of T1 general tax returns, the corresponding notices of assessment, proof of business ownership, and recent financial statements if you have them.
For an alternative income verification approach, business bank statements showing deposits, a current profit and loss statement from your accountant, and potentially contracts or invoices that support the income picture.
And beyond documents, come with a clear sense of what you're trying to accomplish. Are you buying, refinancing, consolidating? What's your timeline? What does your down payment situation look like?
Those answers shape which lenders make sense and which approach to income documentation is worth pursuing. Chris Genova can move quickly from that first conversation to identifying the right fit, but the conversation needs to happen early.
The cell is on from 7 in the morning until 9 or 10 at night. Because that's usually when business owners actually have a minute to talk.
You can reach Chris directly through chrisgenova.ca or connect on LinkedIn. And there's more about his approach to self-employed mortgages through the Authority Hub profile as well.
The lesson here is that a bank decline is a starting point for a different conversation, not a final answer. The system wasn't designed with self-employed borrowers in mind, but there are lenders whose underwriting models were.
And the broker who knows which lender to go to, and how to present the file, is the difference between an approval and a decline that didn't have to happen.
That's the work Chris Genova has been doing in Grey Bruce for 26 years. It shows up in the outcome.
Chris Genova is a mortgage broker in Grey Bruce region, Ontario, specializing in self-employed mortgages.